The big sell-off in IT stocks dragged the Wall Street lower. The Nifty and the Sensex end this week with a 1 percentage point cut. The IT index takes a big beating, sees a fall of more than 8%, its biggest weekly fall in more than a year. Over the next 30 minutes, we'll decode the week on the Wall Street. We'll tell you why the IT stocks are getting battered in trade, and we'll decode whether the tide is turning for the mid-cap stocks. Hello and welcome to Editors Roundtable. I am Reema Tendulkar. With me are Nimesh and Nigel. And joining us on Zoom today is Anand Shah, Chief Investment Officer, Portfolio Management Services and Alternate Investment Funds at ICICI Prudential AMC. Gentlemen, good afternoon. It's been a tough week, particularly for IT, but the rest of the market at least managed to hold on okay.
Yeah, I was to tell that it's a tough week for you specifically. So much noise, so much of news on IT sector. Take us, what's your take?
It was one of the worst weekly falls for the Nifty IT index in recent times. At the session low, the index was down 11.7%, making it the biggest fall since the COVID times, March of 2020. Of course, by the end of it, the index recovered and ended with a fall of about 8%. But it doesn't hide the kind of pain the Indian IT companies have been going through for a while. From their all-time high levels, from the peak levels, we've seen a fall of 30-40%. 40% plus for TCS and Wipro, 30% plus for Infosys. Even Coforge and Persistent have seen very sharp drawdowns, and these were some of the best performing mid-cap companies. I think the big question everyone's grappling is this just another tech cycle where Indian IT companies will be able to pivot, they'll come out on tops, and therefore the sell-off that we're seeing is a bit excessive, it's a good buying opportunity, or is this time really different? Well, Citi has the view, and they're saying that this time it's different. Yes, the Indian IT companies have weathered many storms, Y2K cloud, but this time it's different for three key reasons. One, the incumbency risk. The Indian IT companies this time are much larger. They've doubled in size since the cloud era. So therefore, they're the ones who are going to be disrupted rather than being the disruptor. Secondly, the AI impact is more pervasive. When cloud came, it impacted infrastructure, the way data was getting stored. But the impact of AI is on the operations and the business model, the entire value chain. And finally, the third reason is new AI work is coming in, but it's smaller. It's more pilot, exploratory, and not enough to offset the pressure on the legacy business on account of revenue deflation. But JP Morgan has a contra view. And here they're talking more about the kind of valuations. They're not talking about the business impact per se, but they are speaking about the valuations where they say the free cash flow and the dividend yield are now screaming deep value. They're saying that these are levels that we last seen during very severe market dislocation like GFC and COVID. And they've laid out three scenarios, and that is very helpful for us to gauge where Indian IT companies are headed. But of course, it depends on what your view is on growth. They're saying that from FY23 to FY25, IT companies grew between 2 to 3%. If you assume that is going to be the growth rate, low single digits, then IT stocks have a downside of 10%. But if you think it's going to get better, maybe IT companies can clock in a growth of 5-6%. Better than what we've seen over the last 3 years, but not at par with the long-term growth rates, then maybe stocks stay where they are. But in the bearish scenario, if you assume that AI is going to severely impact the entire sector, there's going to be no growth, a 0% terminal growth, then the downside risk seen for the IT companies is more than 30%. But that's the way the brokerages are still very divided. The pace of innovation has been so rapid that people are still coming to terms with what the impact is going to be, to the extent of the impact. The Indian IT companies we've spoken to do believe that the disruption is going to be very manageable. They've completely said that risks of existential crisis or the fact that the entire pyramid structure, employee pyramid structure, is going to change is overblown. But the street is a worried lot. Maybe what we saw, the recovery from the day's low on an intraday basis, could suggest that maybe the pessimism got done. The pendulum swings on both sides.
Let's get Anand's view then on this one. Thanks, Reema, for that. Anand, what do you make of it? The tech wreck all through the week, and from the recent highs, well, some of them have corrected big time. How would you view this? Do you think they can get past this challenge? And more importantly, the price-wise correction is quite substantial. Good time to look at it, or you believe there's too much of uncertainty and this is an actual threat that you'll just stay away?
Hi, very good evening. So I think, look, price has two elements. Price has the element of EPS and PE multiple, and exactly what is happening just now is, look, there is no near-term risk to the earnings, and even if it's there, it's very marginal. immediately, but what is happening and why the stock prices are, falling the way they are falling is because the narrative is changing. The PE multiples, as Rima spoke about, the terminal value, that what does the AI disruption mean in terms of, one is obviously the deflationary pressures, which will sooner than later will have impact on the earnings also. Revenue growth and earnings both, that would be much sooner. But eventually, how the industry gets disrupted, and to that extent, how long would be this deflationary pressures and this degrowth in the revenue and bottom line, if at all any, and again, that's not given, would be there. And that's all people are speculating / trying to understand, trying to analyze. We believe as the prices, and obviously the prices for the IT services will fall as a low end of the work would be done by AI. It is very much a possibility, like it has happened in the past, that at a lower price the demand goes up. There are new use cases for IT services. People who have not used IT services in their industry structurally will start using, including our industry, where we have not been so much invested in technology. We would invest more. So I think I won't say we know for sure what's going to happen, but as we speak, the starting PE multiples were not cheap, and the growth is completely uncertain. And to that extent, there is a rightly derating that's happening in the sector at this point of time.
Anand, hi. Do you own any IT stocks, any part of the IT segment in your portfolio? If yes, what are you planning to do with it? What are your conversations with companies? Is there a case to continue to hold on when there's so much uncertainty?
So again, we've been sort of underweight to zero in IT for almost last 4 years, and partly also because what we are discussing today is not new. It's been there for a while. We always had this fear of deflationary pressures on IT services, initially because of the demand slump, and now more so because of AI. So we always were of the belief that the valuations at which these companies traded versus the growth opportunity that they offered was not commensurate, and to that extent we were underweight. We are watching this space very closely. We were thinking, or at least nibbling some bit of adding a percentage point here and there in IT services in our portfolios. But now this is a completely new scenario, and to that extent we continue to evaluate this sector. Again, I'm repeating, we don't have a final word on this. We don't believe we exactly understand the implications of various developments in technology at this point of time on the long-term growth of the IT services sector. But I will pause here and at least make this point that this is not the first time that the Indian IT services is getting disrupted. So it's happened in the past, and we are in the services business, so we'll have to remain relevant for software development. We'll have to remain relevant for even execution, which is a new software as and when gets created. Interfacing that with the enterprise software is another job that we do, and plus the various infrastructure and maintenance work which we anyways do. So I think there's a lot of part which will not change, and some of the part which will change.
Sure. Anand, are you fearing any second level impact on any particular sectors because of this big drawdown in the IT names? Because, there could be sentiment impact on jobs, there could be sentiment impact on the real estate as well. Anything that you're looking to avoid now, given such a sharp fall in the IT names?
So look, again, yes, we worry about all those, and we keep on doing our channel checks. There are no early signs of slowdown in terms of the offices which are being hired by GCCs. But nevertheless, look, it would be naive on my part to say that the other sectors are not going to be impacted. To me personally, while there is one-off sector which will get impacted negatively, I think many sectors will actually positively benefit. Those who would consume AI and benefit from the lower cost, lower number of people that you would need. So indeed, your question is right, that would there be job losses? There would be job losses not only in IT sector but in other sectors also, because a lot of repetitive jobs which otherwise being done by a human being would be replaced And to that extent, yes, we look at opportunities as well as threats across companies, across sectors, to see how individual businesses are adapting. So when the internet banking came, when the mobile banking came, the banking and financial services also had impact. The number of people walking into the branch, and to that extent, the consumer-facing employees in the branch, the need for that keeps on coming down. So I think all the gamut of services business and the manufacturing business will get impacted by AI.
All right.
Okay, that's on the tech sector and the kind of disruption it's going to have, not just on services, but even in our day-to-day lives. But, Nimesh, the earnings season, the fag end, and it's not been bad, particularly for the mid and small caps.
Yeah.
And stocks have corrected, very sharp drawdowns, 30-40% in some cases. When you speak to people, what's the reading on mid caps? Is the tide turning?
That's what, that's a big question. In fact, I was at the conferences, and even there, I similarly asked a lot of the fund managers on basically, is the tide turning for the broader markets? And there are enough indications to suggest that maybe there is a tide which is turning for the broader markets, and you can look to bottom fish here. I'll give you some top numbers first. Y2D, look at the indices on how they have performed. The mid-cap index is absolutely flat. Given that there is so much of pain in the Nifty in the broader markets, the mid-cap index is flat, small-cap index down just 2%, and micro-cap index down just 1.4%. In the carnage that we're seeing in the bigger names, this is relatively an outperformance to my mind. The Nifty is down 1.2, and vis-a-vis, if mid-cap index is flat and small-cap is down 2%, looks like it's a bit of an outperformance there. And the Bank Nifty, of course, is a big gainer there, up 2%, Y2D. This is the indices in the since the beginning of the year. Now, as Rima rightly pointed out, if you look at the Q3 earnings, if you dissect the PAT growth for across sectors, it is in the large caps, the PAT growth is 13%. In the mid cap, it's 16%. In the small cap, the PAT growth is 32%. So clearly, there is outperformance in terms of earnings as well in the broader market stocks. Now, in the last couple of years, the big trend has been the insiders were selling. That is the promoters, the private equity. They've been selling a lot. Now you're getting a change of creeping happening from promoters and strategic investors. Some 4-5 names I'll highlight. Vodafone Idea, the promoter has been doing creeping acquisitions. KMB has bought nearly stake worth 50-60 crores in the last couple of days in Vodafone Idea. In the last 2 days, there has been a lot of updates coming in from Bharti Airtel in terms of doing creeping acquisition in Indus Tower. So again, a bit of insider buying there. OneSource, the stock has actually collapsed after the Q3 weak earnings. And now at these levels, you're seeing a bit of creeping from the promoters as well. Nearly 4.5 lakh shares is what the promoters bought. And even Kalyan Jewellers, right? I mean, it's been a big underperformer to the likes of Titan and all. And now after Q3 earnings, we saw a bit of nibbling and a bit of creeping from the promoter in Kalyan Jewellers as well. So that's also a bit of indication that maybe the promoters themselves are finding a bit of comfort at these valuations. Now just look at the big winners in the last, since the beginning of the year in the broader market names. And many of them are getting benefited also because of the change in the overall US-India deal and the US-Europe deal as well. So you'll see a lot of winners in that name: Avanti Feeds, Apex Frozen, GE Power. A lot of these small and mid-cap names have gained 50, 60, 70% in a very short period of since the beginning of the year. So clearly, it looks like there is a bit of outperformance coming in the broader markets. Lastly, I just looked at the 4 indices in the month of March. Bit of mid and small cap, there is a bit of volatility. Last year was quite good. The previous year was a bit weak compared to the Nifty and the Bank Nifty, which have consistently done well in the month of March. So you might see a bit of volatility because of various factors in the March, because of unwinding of book and everything. But broadly, if we look at the indicators, and when I talk to some fund managers at the ground, they do suggest that maybe you're seeing a bit of tide turning for the broader market. So let's ask Anand as well. Anand, what's your sense? I was reading your start of the year newsletter, and you suggest that now the time is to look at micros and not macros. Is that something that you're also very bullish on, the broader market names and small and mid cap stocks?
Indeed. So what happened last year was very interesting. One, obviously, we were coming out of a very low growth. Last year was a growth issue, both on the broader economic front as well as on the earnings front. We had, having said that, we had some support coming back in terms of fiscal spending as well as monetary easing. So as we speak, starting into 2026, we believe from a broader economic point of view, we'll see gradual recovery. I'm not going to see a V-shaped recovery, but we're going to see gradual recovery. And that would offer opportunities to identify businesses which sort of got impacted last year because maybe the credit market was tight or the growth in general or capex, government capex was slow, and to that extent individual. The second element that happened last calendar year had been the India's underperformance versus emerging markets and global markets, particularly India being an anti-AI play, whereas the world was all talking about only AI last year. So a lot of equity money moved from India or similar nations into Korea, into Taiwan, into NASDAQ, and so on and so forth. So we had an extreme move in the markets where AI stocks and AI-related stocks took the frenzy, and India significantly underperformed, almost 30% underperformance versus the global emerging markets and global markets. So obviously, the India's premium to the global markets also came off. Not that India became cheap, it's just that the global markets became very expensive. So to that extent, there can be some reversal of flows also as there is some bit of slowdown or sort of a unwinding of the AI investing. A little bit of a sell-off in the AI stocks can lead to money moving back into emerging markets, especially India, or in the old economy markets, which is including manufacturing and other pieces of the economy. So we are very bottom-up this year. Not that we are never a bottom-up, but more importantly, we went out and told people that this year will be year about stock picking, about identifying which businesses, and you would have sectors where some businesses will do well and some businesses will not do badly. So a lot of focus on identifying businesses will recover, which will benefit from the recovery in the economy and participate. Similarly, you already seen YTD what's happening into a particular sector, IT sector versus what's happening to the other sectors.
Yeah, got it, Anand. I'll tell you what, we'll just slip into a short break, telling our viewers not to go anywhere. We'll come back. We'll continue the Decode Market Action with Anand. Stay tuned.